Hi, welcome everyone, and thank you for joining tonight. My name is Michele Ferrario. I'm the co-founder and CEO of Stashaway. Today I'll be the host, but the main speaker is going to be Stephanie, our Chief Investment Officer. Thank you, Stephanie, for joining. And
Hi,
Stephanie,
Michele. Hi, everyone. Yes.
yeah, and for the first few slides, which I will present, I will need you to help me click forward. So maybe before we do that, tonight we're talking about the second half of 2024, and we're trying to look forward. As hopefully you know, nobody knows what's happening, what happens in the future, not even Stephanie. And while obviously, we do, and a lot of other analysts out there do a lot of work on trying to predict the future. Predicting the future is impossible. And what you can do is understanding what are the risks that are out there, what are the opportunities that are out there, and position yourself in a way that makes you comfortable, irrespective of what the scenarios that will unfold will actually bring to you. Okay, so the idea today is just to understand what are those forces, and I'll let then Stephanie later talk about those in quite a bit of detail. Stephanie, if you can just go forward. Yes, here. So with this QR code, you're going to be able to leave us your contact numbers in case you want us to get in touch with you because you have further questions. We're going to show this QR code again at the end, but you might want to, kind of take a screenshot now and put your name and details there already, so that again, if you have any further questions, somebody will reach out to you and respond. You can also, if you have any question that comes up to you in the next few days, you can use the email support@stashaway.com to kind of ask our team any question you might have. Okay, Stephanie, next please. As I mentioned, today we have one main speaker, Stephanie, and I'll just help hosting the event and give you a bit of introduction about Stashaway and managing the questions at the end. Talking of which, please use the Q&A button available on Zoom to ask any questions, and at the end I'll try to go through them and ask as many as possible to Stephanie. There is a lot of people in the call, so I can't guarantee we're going to be able to answer all questions, but I'll do my best to go through at least the main themes. As a quick introduction to me, I'm the co-founder and CEO of Stashaway. So started building Stashaway together with initially my co-founders and then a larger team. Today we're 150 people across 5 countries 8 years ago. Stephanie, do you want to say a couple of words about yourself?
Yeah, sure. Hi, everyone. My name is Stephanie, and I am the Chief Investment Officer at Stashaway. Me and my team actually manages the platform of investment portfolios on Stashaway platform. I joined Stashaway about 4 years ago, and prior to that, I have been managing multi-asset portfolios for institutional clients, family offices, as well as for companies like Goldman Sachs. So I'm very, very happy tonight to be able to share with all of you what we think about the second half of this year.
Perfect. Okay, disclaimer, this is, educational and informational in nature. So if you want advice, you need to download the Stashaway app, and within the Stashaway app, there is advice embedded, including asset allocation advice, which is what Stephanie will talk a little bit about tonight. But tonight is only for educational and informational purposes. Yeah, next please, Stephanie. So 3 parts tonight. The first one, I will give a very quick introduction to Stashaway for those of you that might not be familiar with us yet. There is around half of people in the call are clients from Singapore, Malaysia, Thailand, Hong Kong, and Dubai, and half are not clients. So I'm talking mostly to the non-clients for a second, and maybe to the clients as a refresher. And then Stephanie will actually take the lion's share of the time we have talking about second half market outlook, and then we'll have as much time as we can dedicated to Q&A. Stephanie, if you can click forward, thank you. Yes. So as I briefly mentioned, we are live in 5 markets. We're in Singapore, Malaysia, Thailand, Hong Kong, and Dubai. There are current today. There are clients and non-clients from all of these markets. We are licensed in each of these markets from the various regulators, so MES in Singapore, SFC in Hong Kong, etc., etc. We are a fund manager from a licensing perspective. We are backed by blue chip investors, including Sequoia, including Fidelity, including Hamilton Lane, and many more. Your money, whatever product you invest in, your money is always with a custodian bank. So whatever happens to Stashaway, your money is always safe. that's the structure of every fund manager. As a licensed fund manager, this is how we work as well. We won a bunch of accolades. I'm not going to go through them. Maybe let's go through the next page, Stephanie, where I'm going to briefly speak about what we offer. So we offer a few different products. Our core portfolios that you see in the middle of the chart is what we started with, and that's enabling clients to build diversified portfolios across asset classes. We have a few variations on it. We have our general investing managed by ERAA, our economic regime-based asset allocation. That's going to be the core framework that Stephanie might mention a couple of times later. We also have general investing managed by BlackRock, where the asset allocation comes from BlackRock. We have flexible portfolios where you can build your own asset allocation, and income portfolio where you can generate income. We have a broad cash offering. What you see here is the Singapore offering, where you have simple guaranteed, but as you can see, this diverge a little bit by market. So we have US dollar cash yield, which is investing in treasuries. We have Simple Plus available only in Singapore, that yields 4.5% in Singapore dollars. Simple is available in Singapore, Middle East, and Malaysia with different yield to maturity because obviously it's currency specific. And Simple Guaranteed available in Singapore in both Singapore dollars and US dollars. I'm not going to talk in details about thematics. That's kind of a way to get easy exposure to specific investment themes in a diversified portfolios. And for high net worth individuals in Singapore, we offer private credit, private equity, venture capital, angel investing in crypto. In Hong Kong, we offer private credit. Okay. Next, Stephanie. These are a few screenshots of how the app works. So it's obviously very intuitive, very simple to use. We try to make things simple. So the underlying investment logic is very sophisticated. We give you extreme visibility over how things work, but we also try to simplify and make it easy to manage and easy to understand and simplify your choices. We do have, as I mentioned, a few different products. So you can choose a portfolio made by expert. This is the general investing managed by ERAA, the Stashaway framework, or managed by BlackRock. But you can also create your own flexible portfolios, build, deciding whether you want over allocation to China, to gold, to the US or US equities, or maybe to a specific sector or a specific maturity piece in the bond yield curve. Maybe if you click next. Lastly, this is a couple of examples of our general investing portfolio. These are the Stashaway managed, so the economic regime-based asset allocation. ERAA managed is a systematic asset allocation regime. We think about it with a risk-first approach. So you will read SRI at the top. SRI stands for Stashaway Risk Index. It's in practice 99% VAR for those of you that might be familiar with the risk terminology. So SRI 36% means there is a 1% probability of losing 36% in a given year. So it's a highest risk portfolio we have. The lowest risk is 6.5%. This is talking about investment portfolio. Then, of course, we have the cash products that have even lower risk. As you can see, we've done the portfolios have done quite well over the last year and a half, posting returns between 10 and 18% in 2023, depending on the risk level, and between 4 and 10% in the first 6 months of 2024. This is driven obviously by the asset allocation. If you actually extend it to 2022, when markets did particularly poorly, our portfolios on average have outperformed same risk benchmark by 6.7 points between January 2022 and end of June 2024. So kind of across the ups and downs of this present cycle. When you look at asset classes, you see there all the three portfolios are quite diversified with equities and bonds. Obviously, the more risk you take, the more you're going to have equity exposure. The less risk you take, the less equity exposure you're going to have. And there is also quite a bit of diversification across geographies, with the US being the largest market and the largest global economy, obviously taking a bit of the lion's share of the portfolios, while though having diversified exposure to a number of other countries. I think you can go next, Stephanie, and the floor is all yours. Hopefully, I did a decent job at introducing the session, and I'm very much looking forward to listening to what you have to say.
Well, thank you, Michele. And let's jump into the next section of tonight's agenda. So basically, we have titled tonight's presentation to be Putting Cash to Work. And before actually I start to present our view, I'd like to kind of take a poll and get everybody moving a little bit. So obviously we are in a virtual environment, but we'd like to do a mini poll. So if you would be kind to scan this QR code, we have 4 questions that we are prepared to ask the audience here. And I would encourage everyone to participate so we can get a taste of what we all think collectively as a group. So perhaps I'll give everyone maybe 2-3 minutes to scan and answer the questions, and we'll come back with answers after these 2-3 minutes. So let's start the poll. If anybody has any question or aren't able to access, feel free to, I guess, type it into the Q&A, and our team will be very, very happy to assist you. So just as a, I guess, as a teaser, there's 4 questions, 3 of which are about markets, and 1 is about AI, which is I guess, a topic du jour. So I'll check on the poll results. So I think I need to stop sharing for a bit.
We are still seeing your screen, huh? Stephanie, in case you didn't want to share the screen. You want to keep it
No, this
secret?
is this is the Slido screen, right? So yeah,
Yes, yes,
I think
we're seeing, we're seeing the slide screen. No, no, I
exactly
know.
it. Yeah. We have 100 people like doing the polls. So let
That
me,
sounds like a decent enough
yes.
to see
So
the
let's
results.
go through the questions and I guess what the answers are. So first question, do you believe global equities will maintain their gains in second half this year? We have 3/4 of our audience saying yes, so 70% yes, 30% no. We'll be actually, I mean, this is a very interesting question, which of course we'll answer during the rest of the presentation. But majority of us thinks that yes, the bull market can continue. Next question. Do you believe interest rates will stay high for long? Actually, a more split decision here. I guess 56% slight majority thinks that interest rates will not stay high for long, but still a very, very significant percentage thinks that we're into a higher for longer environment. Third question, do you have a habit of dollar cost averaging into your investment portfolios? This is actually music to my ears because actually, I mean, our client base, our non-clients are very, very good at having good habits and having the habit of dollar cost averaging into your investment portfolios. So very, very good result. I'm
So
very
if I
encouraged
can
by
say
this.
something, this is great. And maybe if I can say something to the 27% that said no, if there is one takeaway that you hopefully will take away from tonight, is that you should start having the habit of dollar cost averaging to an investment portfolio, whether it's with Stashaway or somewhere else. I hope it's with Stashaway, but just, do it, diversify, and do it over time.
Yeah. So hopefully we'll do a good job of convincing more people to do it. Last question. How useful have you found AI to be helping your productivity? 55% says nice to have, but also quite a significant percentage of people, 27%, thinks that it's become indispensable. 13% try, not very helpful, 5% not useful at all. I think this is actually a very interesting result. I'm actually surprised that 26% of us thinks that it's becoming essential. So there you go, 4 questions. Hopefully you all enjoy the poll. And with that, let me get back to our main presentation for tonight. Okay, so tonight's kind of market section is going to be divided into 3 subsections.
We're not seeing the slides. We're seeing something else. We're seeing the Slido actually.
Oh, still? Oh, sorry. Is this?
Yes, that works.
Okay, nice. All right, thanks. And sorry for the hiccup. So tonight it's going to be divided into 3 sections. First of all, we'll go through a quick 2024 first half recap, and then a quick look at how Stashaway portfolios have done. And then next up, we're going to talk about our thoughts about the rest of the year. And then lastly, and most importantly, I guess the big question is how do we implement it? How do you put your cash to work? So let me just walk through or give a preview of tonight's key takeaway, so you can actually have some, I guess, kind of guideposts as we go through the slides. The first key takeaway is that we think a global recovery is taking shape. This recovery means that basically growth will be higher, but also the implications that inflation could stay higher for longer as well. Our ERAA investment framework has shifted to a regime of inflationary growth a few months ago. And basically what that implies is that we are actually able to put more cash to work to be invested in riskier assets. A third key bullet point or key takeaway that we'd like to talk about tonight is that the bull market should broaden out. And within our ERAA portfolios, we're overweight in cyclical equities and geographies such as Japan and India. We'll also explain why gold serves as a good balancing asset under this kind of environment. Fourthly, Stashaway's general investing portfolios have posted solid positive returns in 2024 year to date, 4.7% on average. Of course, as McKelly mentioned, it differs by risk point, but across risk points, we show a 2% outperformance for our same risk benchmarks year to date. Lastly, and this is one key takeaway, if nothing, I like to put in everybody's mind when investing, what's most important to remember is that it's time in the market, but not timing in the market that will get you sustainable long-term returns. So first up, let's go through what happened in a very quick recap. So this is a chart that shows you very, very colorful boxes. Now, each one of these boxes actually represents a major asset class, and these are ranked by the relative performance in the respective years. So take, for example, if you focus on the right-hand side, you can see that there's year-to-date, and next to that, that's 2023. Now, without focusing into exactly what's going on in these boxes, what you notice quite quickly is that the colors actually look quite similar, especially for the top 3. So for example, year to date, what are the top 3 asset classes that have outperformed? We start from the top, it's large cap equities, international equities, and followed by small cap equities. So largely equities have done very, very well in year to date 2024. What hasn't done so well, these are bonds, these are REITs, which actually has been the case also in 2023. So when we think about what's going on in 2024 in the past 6 months or so, we think that actually so far it's been a continuation of 2023. And why is that the case, right? We've all heard about all these kind of headline news about, oh, is the Fed going to cut interest rates? Is inflation coming down, et cetera, et cetera. But if you kind of zoom out into, I guess, what happened actually to asset classes, this is a very, very good chart that shows you nothing much has actually changed despite all the headline noises. So what does this chart show? This is actually the US 2-year Treasury in terms of how much is yielding. So the interest rate on a 2-year US Treasury. Now, as you can see here on the left-hand side, US Treasury went through a period where the interest rate rose very, very quickly from almost 0% to 4% in 2022. Since then, actually, I mean, this 2-year interest rates have been in a range, right? So what this red box here shows that the 2-year interest rate has actually been fluctuating between 4% to 5%. So the reason why this is the case is because we're actually stuck still in a high inflation environment. And I mean, despite kind of month-to-month data that shows, oh, inflation coming back, inflation kind of falling, still, I mean, we're in a similar regime in terms of inflation for the past kind of 18 months or so. However, something did change, and this is, of course, if you look at this chart, there's kind of an exponential growth in terms of the line. I mean, this chart actually shows you the market cap of a company that we all get to know very, very well. It's called NVIDIA. And as you can see, this company actually rose from kind of 0.5 trillion market cap to almost actually now over 3 trillion in a matter of 1.5 years. So it looks like actually in the past 6 months or so, basically AI has been kind of the only story around town. Now, I talked about interest rates kind of staying higher, and also it seems like AI was the only story. However, there are some changes that ERAA has detected in the past few months. And this is actually based on the data that we monitor on a real-time basis. So what happened in the last few months is that we're seeing global cyclical growth coming back. There's been a recovery in the manufacturing sector. And that actually triggered our reoptimization of our ERAA managed portfolios. So for clients who have been with us for a very long time, you're all very familiar with these 4 quadrants. But I'll just do a quick walkthrough for audience, those of us who are not Stashaway clients. So this, I mean, quadrant is basically a kind of a definition of the different regimes in a economic cycle. And the way we define the economic cycle is by the axis of growth and inflation. And as you can see here, the labels are actually quite self-explanatory. So if you look at the left top corner, you can see that this regime is labeled good times. Now, what is good times? Good times is when growth is actually high and inflation is quite low. And the reason why this is good times is because companies actually make a very good earnings growth during this period. Because when there's economic growth, they see revenue growth. And if inflation is low, margins actually are expanding. So we all know that when we invest in equities, it's basically earnings growth that we're investing in. So in this kind of environment, equities actually do very, very well. Now, as the kind of the cycle moves along, and as companies spend more money, consumers spend more money, the inflation starts to heat up. And when inflation starts to heat up, then we go into inflationary growth environment. And in this environment, I mean, still equities actually perform decently. However, this is an environment where the central bank will start to tighten monetary policy. So this is when kind of things become a bit more choppy. And also, if you invest in fixed income because the interest rates are increased, fixed income return is actually deteriorated. Now, the next cycle is if central banks actually tighten enough, then we move from an inflationary growth into stagflation, where growth actually starts to stall. Now, the last box is, I think, something that we're all very familiar with. It's basically a recession where, I mean, growth slows down so much that it drags inflation down, and the economy actually goes into a very severe slowdown. And in this recession environment, equities typically fall quite a lot, but bonds would perform as a very good balancing asset. Now, if we think about kind of where we are in this macro cycle, we were in kind of stagflation since December 2022. However, with a recovery in the global manufacturing sector, we are detecting that we were returning to inflationary growth in kind of second quarter of this year. So basically, it's coming back to a relatively friendlier kind of environment for risky assets. And hence, when we actually trigger a reoptimization or kind of an adjustment of all our ERAA managed portfolios according to the change in regime, we have actually increased our allocations to risky assets. Now, this is a chart that shows you kind of what the asset allocations are for different SRI portfolios. So starting from the left, SRI 6.5, that's our lower risk portfolio. And then on the right, 36, that's our highest risk portfolios. Now, when we, I guess during the stagflation period, what we've done, just a reminder for everyone, is that we have significantly overweighted cash equivalents. Now, in this chart, that is colored in dark blue, and those are the ultra short government bonds. The reason for that is twofold. Number one, it offers very, very safe assets. And also, secondly, because of the high interest rates, it actually offers decent returns for very, very, very low risk. Therefore, I mean, in our old kind of allocations, for example, for SRI 6.5, we have 50% allocated to these cash equivalent asset classes. Now, as you can see, we've actually reduced that allocation from 50% to 34%. And what we've done is that we've allocated a bit more to equities. So equities are the bars that are colored in purple. These are divided into US equities and global equities. So across all portfolios, we actually increase allocations to equities. We have also increased kind of slightly our allocations to kind of high grade or higher yield bonds in emerging markets, for example, or corporate bonds to generate higher returns. And then lastly, you notice that for gold, for example, we've actually pared back some of the gold allocations, given that, I mean, gold is also a balancing asset. We still like gold in the long term, and we'll explain in later part of the slides. But in this environment, we like to kind of put more of these allocations into risky assets that will generate higher returns. One thing that we haven't changed from a stagflation to an inflationary growth environment is that we still remain underweight in bonds. And the reason for this is that in a higher for longer or inflationary environment, bond returns typically suffer. And we've seen that in 2023, and we continue to see that in 2024. Now, this chart shows you the returns of world equity versus world government bonds. The top line is equities. So you can see here, year-to-date equities actually returned 11.6%, whereas bonds, which is the lighter blue line in the bottom, year-to-date is still returning negative 4%. So given our allocations, I mean, ERAA actually still maintained to or managed to deliver strong performance year-to-date. These are our returns year-to-date for the respective I guess, portfolios in different markets in the local currencies. So, for example, I think one thing to point out is that on average, our portfolios have returned 4.7% in US dollar terms. Of course, in I guess in markets like Thailand, we have returned much higher, 12.8%, because of the Thai baht depreciation. So the other thing I would point out is that across all our portfolios, we've managed to outperform our same risk benchmarks by about 2 percentage points. As Michele mentioned, our portfolios have also been able to kind of maintain our outperformance during periods of turmoil. Now, this chart here shows you the Stashaway general investing portfolio average, which is the solid line versus our benchmark average through the period of the last kind of, I guess, 1.5 years. So as we all remember, US equities or global equities suffered quite a significant drawdown in 2022. That includes both equities and bonds. And because of our kind of more defensive allocations in Stashaway GI portfolios, we managed to outperform on the downside, and we still continue to outperform on the upside. And if I look at kind of how Stashaway general investing portfolios have performed on average from the troughs, they are up 27% from the 2022 lows. So with that, very, very quick recap. Let's get to the more interesting bit, which is what we think about kind of the next few months. So I guess, as I alluded to, we are seeing actually a recovery in terms of the global manufacturing sector. So we think this is actually very, very good news for investors, because if we think about kind of the last 18 months or so, there were not a lot of, I guess, choices when you're investing in equities. A lot of that is focused on the Magnificent Seven, AI, tech, because the rest of the economy is actually suffering. Now, what we're seeing here in this chart, for example, is one leading indicator that we like to refer to a lot. This is actually the S&P Global Manufacturing PMI. It tracks kind of the global manufacturing cycle, and you can see that there's a line in the middle, which is 50. Whenever the reading or the chart goes above 50, it means that global manufacturing cycle is expanding, and if it's below, it means it's contracting. Typically, if you look at equity returns, it has pretty good correlation with this indicator, which is why we like to take reference of this indicator. So we're seeing a rebound in business conditions across a lot of the manufacturing sectors. And the great thing is that it's also quite broad-based from a global perspective. So this chart here, you see a lot of green and red boxes. Each one of these boxes actually represent a month. So on the very, very right-hand side, I mean, that is kind of the latest month. And if a box is green, it means that for that particular region or country, manufacturing is actually expanding. And the greener it is, the better activity is. And on the other hand, of course, like if it's red, it means it's contracting, and dark red means it's contracting quite substantially. So one thing that you notice that jumps out from here is that more and more boxes or more regions or countries are actually turning from red into green. I think most notably, you can see that in the US, that is kind of that has I guess that has been changing in the last few months. And also, I think across Asia, you can see a lot of green as well. So, I mean, those are areas where we're seeing kind of more broad-based recovery. Even in Europe, we're seeing, for example, manufacturing hubs like Germany seeing greens in the last 2 months. So, I mean, a very, very good sign. And I mentioned that manufacturing cycle actually correlates very closely with equity returns. And I also mentioned that equity returns actually depends on earnings growth of the companies. And this is a chart that shows you that there's a tight correlation for the manufacturing PMI versus earnings for corporates. So manufacturing PMI is actually plotted in the yellow line, and you can see some blue bars. I mean, these are 12-month forward earnings per share for companies that are in the MSCI World Index. And you can see that, I mean, for kind of most of 2022 and 2023, there's not much growth in terms of earnings. And compare that with kind of 2021, when we had a very, very robust kind of earnings backdrop. Right now, things are starting to turn, but it's still very quite early days. And we think that actually there's more upside to this chart as we see kind of manufacturing recovering further. So that was a good news. Of course, everything has kind of the two sides. The bad news is that if inflation is if growth is actually coming back, it may actually put upward pressures on inflation. I think if we think back kind of the last 18 months or so, inflation has come off. So if you look at this chart here, it shows you different measures of I guess price levels from the PMI index. You can see that they all peaked in 2022, and they have started to come down in 2023, and also in year to date as well. Now, the one thing to notice is that some of these kind of price decreases or kind of disinflationary forces seems to have plateaued in 2024. And when we look at our kind of one of my favorite charts, which shows inflation divided into supply-driven and demand-driven inflation, I mean, we're, I guess, less optimistic that, I mean, inflation will be able to come down very, very quickly. And this has been our argument, I think, for the last 6 months or so. When we first gave our 2024 outlook, we said that when we observe what's going on in inflation, we're seeing kind of more disinflation in the demand-driven side, but not so much in the supply-driven side. Now, I guess when we think about kind of these demand-driven and supply-driven, what is demand-driven? Demand-driven is basically things that get heated up because everybody is more well off, right? If companies are spending, if people are getting more money in the pocket, they go out, spend more, and drive up prices. The supply-driven kind of elements are kind of supply constraints. For example, during COVID, we had supply chain limits. Right now, I think what's driving kind of the supply-driven inflation is actually labor. And when the Fed tries to kind of put down inflation, they know how to kind of fight demand-driven inflation, because all you need to do is to slow down the economy and demand-driven inflation will go away. And indeed, that is what happened in the last kind of 12 months or so. Now, what's kind of more sticky, what's more difficult to fight is actually the supply-driven inflation. And this cannot be solved by increasing interest rates, because you need to, for example, if it's a oil supply problem, you need to build infrastructure, and that takes time. Now, we say that actually this time is not so much of an oil supply problem, but it's actually a labor supply problem. And for those of you who have been following us for the last year or so, you've seen this graph before. So a year ago, when we argue that inflation is kind of here to stay, this is a key chart that we showed. Basically, I mean, what this chart shows you is the US labor force in the dark blue line. And as you can see here, from 2013 to 2020, the US labor force actually grew at a pretty consistent rate. Now, during 2020, there was a big fall off, and actually about 8 million people left the workforce. And not all of them actually came back afterwards. So if we do an extrapolation of the trend pre-COVID and compare that with kind of how many workers we have today, there's still a gap of about 2 million workers. And we think that, I mean, this is actually what causes the structural shortage in the labor market. And that explains why, despite all the interest rate increases, despite kind of everybody saying, unemployment will start to skyrocket, we still think there's this gap that supports a very strong labor market. Of course, I think some of the recent technological improvements can help to kind of narrow this gap. For example, the adoption of AI, and almost 1/3 of you says that you're using AI every day. And from my personal experience, I mean, using AI actually helps a lot with the, I guess, shortage of labor. So we're not saying that 2 million has to close. Perhaps with AI, I mean, we don't need to close that, but it's definitely giving very good support from a labor market perspective. We think actually, I mean, if you look at the data, yes, the labor market has actually been cooling down. So this is a chart that shows you a ratio. So this ratio, you can see that it peaked at 2, now it's 1.2. What is this ratio? This ratio is basically the ratio of jobs opening versus unemployed. So for example, 1 is actually equilibrium, because for every unemployed person, there's actually 1 job opening. So there's a 100% match. Now, when in 2022, when the ratio got to 2, it means that there's 2 job openings for each unemployed person. So that is kind of really, I mean, a tight labor market. Now we're getting down to about 1.2. So it's still not kind of back to a kind of more normalized level. So, but I mean, what we're seeing is that if the ISM manufacturing, if kind of the PMI starts to rebound, the percentage, kind of the job openings may start to rebound as well. And this is a chart that shows you the historical relationship between job openings and the PMI, which is the ISM manufacturing. So, I mean, one reason why we're cautious of kind of the labor market remaining quite tight is because if ISM or if the leading cyclical indexes keep rebounding, we may see actually more job openings, which is actually quite logical, right? Companies start to hire again. The other thing that is kind of adding fuel to fire to kind of inflation staying higher is that despite kind of inflation not being at 2%, central banks have started to loosen monetary conditions already. Now, of course, there's still like some debate as to when the Fed will start to decrease interest rates or how many cuts they will have. I mean, market is now pricing in about 2 times of rate cuts. But also very notably, the Fed actually started to slow the pace of balance sheet contraction in June. So this is basically the reverse of QE. I mean, the Fed has been doing QT for quite some time, but I mean, starting last month, it actually scaled back QT already. So of course, this is again adding to a looser monetary conditions. And if you look at the map on top, you can see that the areas of the countries, regions shaded in blue are where central banks have started to loosen policy. So you see a lot more blues there.
Stephanie, can you maybe explain quickly QT and kind of what does it mean to slow down the pace of balance sheet offload so that for people that might not be super familiar?
Yes, of course. Yeah. So basically, post-financial crisis, the Fed has engaged in quantitative easing. So that is QE. So essentially what it does is that it buys treasuries, it buys US treasuries. So therefore, when the Fed can print money and buy treasuries, they basically, what they do is that they inject cash into the economy. Now, the reverse of that is called quantitative tightening. Because the Fed has bought a lot of these treasuries, so they need to kind of reduce the amount that they hold. So they sell back these treasuries into the market. And when they sell it back, the market basically have to come up with cash to buy these treasuries. So essentially, they're draining cash from the economy. So that's QT, quantitative tightening. And the Fed has been doing QT for quite some time. But I mean, what they've announced recently is that they will, I guess, sell less of the treasury, meaning that will drain less liquidity from the system. Hopefully that makes sense. If not, happy to answer the questions later on as well. So given all this, I mean, we think that the ERAA regime will actually remain in inflationary growth for the next few months. But of course, what the system does is that it monitors data on a real-time basis. So, I mean, the above are kind of my best guess of what's going to happen. But if, I mean, things change, our system will actually detect a new regime in real time and make adjustments accordingly. So, of course, in the second half, we have a host of political events. We've just, of course, had I guess, election in the UK, also snap election in France. And then, of course, the biggie is November, US presidential election. It's actually very, very entertaining to watch. But from a market's perspective, I'd like to also kind of maybe talk a little bit more about how we should navigate these volatilities. Now, let me show you some examples. So this chart here shows you the MSCI India index, the India equity market. That was basically in June. So you can see that basically there was a big dip of about 6% on a day when Modi lost majority. Now, of course, then very quickly the market realized that actually, I mean, from a long-term perspective, all the kind of bull cases for India hasn't changed much. So, for example, the fact that the demographics is kind of very favorable for India, and also that there's reforms going on, that is not going to change. So the market actually rebounded very, very quickly. We also put out a note that week arguing similarly. So today, I mean, India is again back to all-time high. So the other example that why we think all these political events would create short-term volatility, but ultimately doesn't matter in the long run, is actually this, right? This was 2016. And I'm not sure if you all remember, but there were two big events again during that year. So you can see there's two dips, one dip in June, the other dip again in November. So hint, second dip was actually when Trump got elected. And the first dip was actually Brexit. So these two were very, very, very big political events at the time. It created volatility in the market, but ultimately, does it matter? It does not, right? Market actually kept going higher. Why is that the case, right? Why are these political events not really significant? Most of the time, they're not significant for markets. There's a logical explanation. If you think about politicians, what they care about is their voters, right? Their voters actually giving them support. And I mean, voters ultimately care about very fundamental things about the economy, right? Whether they have jobs, whether inflation is tame, et cetera, et cetera. So I guess by logically, I mean, most politicians actually need to care about the economy. And therefore, I mean, a lot of times the market reacts to these political events, but ultimately, it's the economy, it's the fundamentals that matter in the long term. So lastly, putting your cash to work, which is also, I guess, the most important part tonight. So a lot of us actually, or a lot of people speak to me and they say, oh, I mean, there's a lot, like actually, I have a lot of my assets in cash because cash is yielding very, very nicely. Now, depending on what currency you have, they have different yields. US dollar happens to have one of the highest yields globally. And like, for example, in Stashaway, we're offering 5.33% per annum in our US dollar cash yield portfolio. Fantastic, right? Because it's basically risk-free. You invest in US treasuries, there's daily liquidity, et cetera, et cetera. But there are other things, or the other thing that people say is, oh, Nvidia is perhaps the only other game in town. And of course, that was a great shot, but I won't go into that. But I think actually there are alternatives, right? And especially as we go into back into an inflationary growth environment. And here is why. So when we look at how different asset classes actually perform under this regime, there are actually alternatives that perform better than cash. So this is a chart that shows you 4 different asset classes, starting from the top, US industrial equities, S&P global equities, and at the bottom, long duration US treasuries. And these numbers are excess returns over cash. So basically, if cash returns 5%, it means that on average, US industrial equities return 10% in excess on top of that 5%, meaning you add, so the total return could be 15%. So S&P global equities, they kind of tend to outperform cash by about 7 to 8% during this period. So of course, the risk is different, right? Because if you remain in cash, there's no volatilities, there's no ups and downs, and you basically pocket that 5% without having to worry about market daily movements. But I mean, if you have a long time horizon and if your risk appetite is higher, then I mean, there are alternatives. I mean, this equity rally has also been quite narrow, right? One complaint that people talk about is that the market is not very healthy because most of the rally is actually driven by AI stocks, driven by Magnificent Seven. And indeed, if we look at kind of the market cap of the largest stocks, they are well, I guess they are very, very, very concentrated even in the index. But when we look at kind of outside of the tech sectors, there are other sectors that actually look quite appealing, or at least from a kind of index point of view, the index is actually not too overvalued or not too expensive. This chart actually shows you the price to earnings ratio of US equities. You can see that in the middle, so there's a S&P 500. Indeed, it's the 4th bar from the right. And we plot a few things here. So you can see that the yellow dot is basically the latest price to earnings ratio. And it's basically an indication of how expensive a market is, right? If the PE ratio is higher, then it's more expensive. If it's lower, it's cheaper. We also plot in dark diamond shape, the 10-year average. And also the box actually represents a 10-year range. Now, if you look at kind of how the latest yellow dot compared to the average and also the 10-year range, you see that most sectors actually are kind of not too overly expensive. True, I mean, it's not cheap, but it's not, I guess, stretching imaginations either, except maybe for information technology, right? If you look at information technology, the latest PE is actually over 30 times, but historical average have been 20. And even if you look at just the Max 7, even though they have been catching headlines, from a valuation perspective, they're not too expensive either. So we think that number one, I guess there is still other sectors that are attractive from a valuation perspective. And number two, even if we look at some of the big cap tech companies, valuation is not too expensive. Why? Because they have actually seen earnings growth supporting the rally. So the rally so far is actually supported by mostly by fundamentals. So we talked a lot about kind of risky assets, how equities perform. I promised at the beginning that I would come back to gold. So we actually like gold as a structural safety asset. And for those of you who have been with us for a long time, you know that, I mean, when we construct portfolios, we like to have a mix of safety assets, and that's how we construct the lower risk portfolios. The reason why gold is a safety asset is actually explained in this chart. So what this chart shows you is two asset classes. So the lighter green is actually gold. The darker green is S&P. Now you notice that during all these kind of different historical periods, financial crisis, Black Monday, Gulf War, equities actually went down by 20 to like as much as 50%. During these same periods, gold, number one, did not go down as much as the S&P. And actually, in many instances, gold actually went up. Gold was actually holding up very nicely. So when you think about putting together different asset classes for a portfolio, what you want to achieve or what you want to put together are asset classes that are uncorrelated with each other. So when one goes down, the other one would go up. That would help to mitigate kind of market volatility. So gold, from this perspective, is actually a very good kind of hedge. And we particularly like it in a higher for longer environment because it's also a good hedge for inflation. And indeed, I mean, that has happened in 2024 so far. So this chart actually shows you the year-to-date return of different asset classes. We've shown equities and bond in the beginning of the chart of the presentation, which is the blue lines. So I've added two more. The gold line is, of course, gold. And you can see a very, very smooth kind of dark line. That is the cash return. So actually, year to date, I mean, gold has even slightly outperformed global equities. So I think this shows you actually a gold's power as a inflation protective asset. And I think it also shows you that I guess there is some structural changes in the market that we need to pay attention to, which is there's increasingly concern about the US deficit in the next decade. So gold also acts as a hedge for a kind of a significant increase in the fiscal spending for the US. I won't go into detail into this. Happy to talk about it, but I think also not just us, but also other sovereigns. For example, China has been buying quite a bit of gold this year. So from a structural kind of long-term perspective, we also think that gold makes sense as a hedge. So this chart actually reflects our ERAA benchmarks, and you can see that different risk points have different mixes of asset classes. I think if you look at a lot of portfolios kind of have bonds and equities as with different mixes as the benchmarks. I think what's a bit differentiated about ERAA is that we've also introduced ultra short bonds, which is cash equivalent, and gold into our benchmarks, given some of the structural shifts that we're talking about. So I think, I mean, we've gone through a lot, and I just wanted to go through a few final charts, and hopefully I believe everyone with some food for thought in terms of how to think about timing the market. So I mean, the question really is, can you time the market? I think you all know that my answer to that is no, but let's go through a thought experiment. So this thought experiment is actually during COVID. So let's rewind back in time a few years, and just imagine that you were kind of holding your equity portfolio in at the start of COVID. I guess we all remember it was actually a very kind of volatile and fearful moment because we didn't know what's going on. It seems like the world is coming to an end, and equity markets fell very, very quickly by about 30% in a matter of weeks. And if you were holding equities, maybe you would have actually, I mean, cut equities because every night you wake up, you see different headlines. And because I think when things go down that quickly, everybody panics, right? And what happened afterwards was that the Fed actually came out and loosened monetary conditions. US and other kind of governments came out with all sorts of policies to try to stimulate the economy, and the stock market actually recovered very, very swiftly. And if you have cut your equity position during COVID, it was very hard to find an entry point because the market basically just rallied all the way through, not just like kind of surpassing the peak, but surpassing it by about 40%. And if you didn't kind of stay invested and you don't have like your equity exposure or your investment exposure at this point at October 2022, you're thinking, oh, actually, maybe the market has overshot, and maybe I'll just wait for a bit and see if the market actually comes back down to 100, and that's when I'll add to my portfolio. What happened afterwards? Let's see. The market did chop around, but it never actually went back to where it was pre-COVID. So even if you have cut everything pre-COVID, it was very hard to get back into the market because it actually traded much higher. And here we are, October 2023. It seems like, I mean, the news is still quite bad. People were talking about recession, and still, I mean, basically, I'm still holding like all my assets in bank deposit, waiting for that chance to get back to the market again. What happened afterwards? I mean, the market actually never gave you a chance. It kept going higher. So I mean, basically, it was very, very hard to time the market because news headlines is always bad. And if you were holding cash, there was basically there was no chance for you to come back to the market. So what is the tool? Can we actually fight this kind of psychological barrier? Luckily, we have actually something called dollar cost averaging. And I think if you kind of think about dollar cost averaging, it's basically doing a monthly savings plan, except for that savings does not go into a savings account, it goes into your investment account. And it's a very good tool to reduce timing risk because it guarantees you that you get into the market. When the market is high, you buy fewer shares. When the market is lower, you buy more. So in a sense, I mean, it's helping you to have a habit of consistently buying through ups and downs. And the great thing about this is that over time, you enjoy the equity upside or kind of the asset class upside using this tool. Some people think that, okay, monthly may not be suitable for me. So we have clients that do weekly or even more frequently. Of course, like that, I don't think doing it much more frequently than monthly actually adds a lot. But I mean, the platform is very, very, I guess, flexible. We designed that way to make it easy for you to do dollar cost averaging. So with that, that concludes our presentation tonight. I'll just repeat very quickly our key takeaways so everybody sort of has something to walk away from. Firstly, we are seeing a broad-based global recovery, and we think that growth can stay higher, but that also means that inflation could stay higher for longer as well. Our ERAA investment framework also detects that we've entered inflationary growth. We adjust our portfolios in April, basically putting cash to work. The bull market, we think, should broaden out. We have overweights in cyclical equities and also in Japan and India. We also like gold from a kind of cyclical and also structural point of view as a balancing asset. Our general investing portfolios have performed quite well. So we have returned on average 4.7% versus 2% for our same risk benchmarks. And lastly, most importantly, I think for the 20-something% who hasn't kind of done DCA or dollar cost averaging, please remember that it's timing the market, not timing the market. That is the most important. So with that, maybe, yeah, I've overrun a bit, but I think we can take some questions.
Thank you, Stephanie. And yes, I will. There are a couple of questions, and maybe I can go through that. Maybe if you want to click one more, I think you go to the QR code. Yes, maybe let's stay here.
Yes.
Maybe before I go to the questions, as a reminder, if you scan this QR code, you'll be able to give us your details in case you have any further questions so that somebody will reach out to you to answer your question. You can also reach out via email to support@stashaway.com. But let me run through the question. The first one is from an attendee, Anonymous, and he says, I have US dollar cash yield in one of my investment portfolio, but it's not doing as well as some of the other investments I have with Stashaway. The performance is lower than what I expect versus other investments I have with Stashaway. So in practice, it's comparing the US dollar cash yield to some, investment portfolies, I guess. Why is that? Do you want to, maybe go back?
Yeah. So let me just go to this slide. So I guess if you look at this slide, you can see that the US dollar cash yield is basically the dark blue line, the Bloomberg 1 to 3 month US Treasury bill index. It goes pretty much in a straight line. So it doesn't matter when you start the portfolio, it doesn't matter which day you're talking about. It's basically very, very consistent. Now, if you look at the other three asset classes, now, of course, like year to date, the bond index has underperformed. But if you look at kind of equities and gold, even though they outperform the cash year to date, there were some periods where they have gone down. So it really depends on kind of which period you're talking about. Because, for example, in April and May, I mean, equities actually went down about 6%. So if we were taking that snapshot, of course, like equities will underperform treasuries. But over time, I think what we're talking about here is that over time, risky asset classes should deliver higher returns.
Okay, so thank you for that. I wanted to ask you about, so there is a question from Danny saying, how much of the equity gains are due to quantitative easing? Is liquidity expected to disappear soon, resulting in a longer term bear trend?
Yeah, so I think I think what he's referring to is the quantitative easing since 2008, because I mean, there's no. I think apart from Japan, which is still doing quantitative easing, actually the Fed has been doing quantitative tightening, which is the reverse of quantitative easing. However, I think the central banks have actually kept I think the monetary conditions actually quite loose. In a sense that if you look at, for example, bond yields, bond spreads, I mean, these are actually very tight. If you look at kind of the communication from Powell, they have actually tried to guide the market that they will start to cut interest rates. So again, when we think about the global liquidity environment is actually quite supportive for risky assets. Now, of course, this is very different from 2022. So during 2022, what happened was that because inflation was spiking very, very quickly, I guess the monetary stance from all these central banks was that they were going to hike interest rates in a very, very fast pace. And indeed, that was one of the fastest hiking cycles that we've seen in history. And that was not actually friendly to risky assets. But now we're sort of seeing a reverse in the sense that if inflation allows, I mean, the central banks actually would have a more loosening stance.
Thanks, Stephanie. So I'm actually going back to a more kind of core question on how to behave. There are two people that ask similar question or the same question really. Kylie and an anonymous one asking, what would be your advice if you have a lump sum of cash? Put into the market now all at once or hold cash and invest this over time during the year?
Yeah, so I think when you think about this question, that lump sum, actually, the first question you need to ask yourself is that, I mean, how significant is that lump sum to your net worth? Now, of course, if it's not very significant, then I would say just get it done. But if I assume that it's quite significant, so in that case, what I would advise people to do is actually to perhaps divide that lump sum into 2 or 3 chunks. Invest part of that today. At least you get one foot in the door and start investing. And for the second chunk or the third chunk, you can either set a time frame or you could set like sort of a kind of market triggered entry point. So, for example, if you divide into 2 chunks, today invest half of that, and perhaps in 6 months' time, invest the rest. Or you can say during this 6 months, let's say the market actually gives you an opportunity and the market retreats by 5 to 10%, then invest that second chunk as well. So in that case, I think ultimately what you want to have is a peace of mind when you invest. And you don't want to be thinking about, oh, did I do the wrong thing all the time? And the great thing about chunking it up is that if you think about having invested your first chunk, let's say the market goes higher, you have invested, so you have kind of gains in your pocket. If the market actually goes lower, then you don't feel bad because you still have more capital and you can take advantage of the market down move to deploy that capital. And the worst thing is actually to just kind of wait around and do nothing. And of course, I think the best thing for for all of us who are earning a regular kind of income stream is to set up the DCA, the dollar cost averaging, kind of in accordance to your income stream. So you kind of keep invested over time.
Thank you, Stephanie. So 2 questions that are related to kind of geographical choices and currency choices. The first one is actually geographical, the second currency. Let me start from the first one. So an anonymous attendee asked, shouldn't we invest more on global equities, especially emerging Asian markets, for potentially higher return? It seems the delta increases more on US equities. He was referring to when you show the reoptimization, chart where there was actually an increase in US equities. So in practice, global versus US and emerging market, particularly versus US equities.
Yeah. So post the reoptimization, we've actually maintained our exposure to US equities. So we've always been kind of slightly overweight US equities and remain so. Because I think if we look at kind of the earnings potential of the US companies in this cycle, and also from a structural basis, I mean, ERAA is still signaling that they will outperform the other regions in developed markets. We have overweights in Japan, for example, because given that we're in a more kind of cyclical part of the cycle, Japanese equities actually consisting more of these cyclically sensitive companies like industrials, financials, tech companies, etc. And therefore, I mean, ERAA has actually over allocated to Japan. Within kind of emerging Asia, ERAA has over allocated to India. There is a kind of a structural story that would support Indian earnings growth for the long term. And also, I think compared to kind of other opportunities in Asia, I mean, India's story, I mean, remains the most kind of apparent, and also it delivers the highest earnings growth. And when we think about kind of equity allocations, we always come back to kind of what kind of earnings growth can a market deliver. We are maintaining our market weight in China. There's a lot of question about, is China recovery coming back? So far, ERAA is not seeing kind of a significant comeback in the data, even though, I mean, it's troughed. So, for example, when we think about whether there's systemic risk in China, we don't think there's systemic risk. However, because the property bubble and the deflationary impact from property will take kind of a few years to resolve, it puts kind of a lid as to how quickly the recovery can take place.
Thanks, Stephanie. As I mentioned, somewhat connected, is talking about Forex. Luca is asking, will you have any insights on Forex? A large financial institution with a red logo in Singapore, and I can add with the name starts with D, is advising that Singapore dollars will strengthen against the US dollar. That has significant implication on how I would put my money to work.
Yes. So when we look at currency, we look at it from 2 perspectives. One is the kind of the valuation of the particular currency, and then secondly is kind of what is the interest rate kind of projection of the US dollar in particular. So I think what we've seen so far is that US dollar has strengthened across kind of multiple crosses of multiple currencies, because US economy is still very strong and US inflation and interest rates actually remain highest globally. So I mean, from that perspective, if you kind of follow our logic of still strong global growth and still kind of higher inflation, that means that US interest rate could stay higher for a bit longer. And then from that perspective, then I mean, US dollar could stay strong versus other currencies. However, when we look at kind of the valuation side of things, it is true that currencies like Singapore dollar or Thai baht or Malaysian ringgit has become quite cheap. So what we're seeing is that I guess what we're saying is that if the fundamentals actually start to turn, meaning that, let's say, if inflation actually starts to fall and the Fed will start to cut meaningfully, there is a kind of significant gap in terms of valuation. So that could trigger a pretty violent move in these different crosses versus US dollar. However, right now, we're still not seeing that condition. So in short, US dollar is expensive, but still supported by fundamentals.
Thanks, Stephanie. So I'm going slightly back to what we discussed earlier, because there is 2 more questions around the same topic. Sorry that I'm flip-flopping, but the question just came now. So Mark is asking, what is your signal to go more overweight on emerging market equities compared to the US? And an anonymous attendee is asking, should I move our investment exposure in China given potential geopolitical tension from US election? So emerging market versus US equities, and maybe specifically China.
Yeah, okay. So I think historically, emerging markets have performed much better in a weak US dollar environment. So that makes sense, because if you think about kind of your return, I mean, those are a lot of the returns are actually driven by the currency. And also in a weak US dollar environment, that tends to be when global growth actually becomes would be quite robust. And emerging markets actually need a very robust kind of global environment to attract more capital. And I think so far we're seeing kind of kind of a recovery in terms of manufacturing cycle, but it's not kind of, I guess we're not deep into the cycle yet, right? It's kind of green shoots and starting to turn, but it's not full on a kind of full on global kind of power on kind of recovery or manufacturing cycle. So I think the other side of the coin is that, I mean, for US dollar to weaken significantly, we really need to see inflation coming back to 2% or coming closer to the Fed's target. So I don't think the conditions for emerging markets to significantly outperform is there yet. And particularly when we look at China, which is of course a significant portion of what drives emerging market performance, I think China still faces some structural issues that they need to work through. Back to, of course, the question of geopolitical kind of conflicts and its impact on China investments. I think what we're seeing kind of increasingly is that China and US or other countries are trying to kind of be more independent of each other. And for example, if you look at kind of the technology developments, China is trying to develop its own technology stack, US the same. And I think really, I mean, regardless of the election outcome in the US, the tide of kind of globalization has turned in the past few years. And I think referring to my slide about kind of politicians actually answering to the median voter, I think if you look at the median voter in the US, what they're saying today on China risk or kind of China becoming the enemy is very, very different from what they were saying a few years ago. So in a sense that it really doesn't matter which candidate gets elected, I think kind of entering a multipolar world or this kind of divergence of technology or divergence of views is going to continue on a structural basis. And this is something we need to take into account when we think about our investments.
Perfect. So thank you. Pete is asking, as great as ETFs used as the instruments to diversify the risk, but having multiple segments, industry, and specific geographical allocation, will that be counterproductive for the purpose of diversification? Maybe let me summarize this. I guess the Kit is asking, ETFs are a broad exposure and help diversify. The fact that in the ERAA portfolios, we actually choose more narrow focus ETFs, targeting a sector, targeting a country, targeting a particular part of the yield curve, for instance, on the bond side. Is that going against the idea of diversification?
Yeah, I think so. If you look at the ERAA portfolios, they are still very, very diversified. So, for example, we still actually have exposure to like global equities, all the different markets, different sectors. I mean, what ERAA differs is that we have slight tilts according to the economic regime. Because, for example, as I mentioned, bonds, equities, actually perform very, very differently under different economic environments. And it helps to maintain a constant risk if you understand where you are in a cycle and adjust the allocations to bonds and equities accordingly. Similarly, for some of these tilts, I think it makes sense to actually still, for example, have exposure to Europe, but because Europe actually growth is not as robust as other places, therefore, I mean, we've actually dialed down our allocation into Europe, European equities. But still, I mean, there is exposure. Now, of course, I think everything kind of also comes into how we risk manage our exposure to different sectors. So, I mean, over the years, we've actually refined our risk management kind of procedures and also oversights in the sense that when we have these tilts, we make sure that these tilts are not so big, such that it kind of loosens the effect of diversification.
Maybe slightly connected to this, Crafty Maker is asking, how does Stashaway protects our portfolio from currency risk from US dollars, as it is currently strong, and it might weaken when the central bank eases monetary policy?
Yes. So I think, I mean, in our ERA portfolios, we're now maintaining kind of I think a market weight in terms of US dollar exposure. Because as I mentioned, the valuation of US dollar is actually quite expensive, although fundamentals still support it. And when the conditions change, when I think the conditions for US dollar depreciation does happen, then what ERA will do is then ERA will actually underweight US dollar and have more exposure to international equities or global bonds or things that are not denominated in US dollar. So that's how we actually adjust currency in our portfolio, and it actually follows the same logic as the other, like as the allocations to different asset classes in ERA, in the sense that it follows kind of the global economic cycle.
Thank you, Stephen. So questions are coming in faster than I can ask them. So,
okay.
So there's no way we're going to be able to answer all the questions. So apologies for those of you that might not get an answer. I'm trying my best.
And thank you for all the questions. Yeah.
Exactly. Thank you for the question. I promise I'm trying my best. I'm trying also to have some sort of logical order, which is proving more challenging than I expected. But apologies if we don't get to your question. There is I lost it. I wanted to talk about the US election. So there was a question here on US elections. So how do you see the US elections impacting markets, particularly yields?
So I guess there's changes every day, and I don't pretend to have the crystal ball of what's going to happen in the next 2-3 months, because I think there's a lot in flux. I think what I'll say is that from a broad market perspective, actually historically, I mean, I guess who will be in charge does not impact the overall market that much. The impact is mostly felt on a sector level. So, for example, I mean, different policies can impact like sectors like healthcare, for example, or military spending, etc. I mean, all these kind of have more granular impacts than the overall market itself. There's actually one great chart which shows you kind of equity return under different presidents or under different kind of party presidency. Actually, there's not much difference if Republicans are in charge or Democrats are in charge. I think if you think about kind of the slide that I showed in 2016, when Trump got elected, a lot of people were very, very fearful, because it was like, oh, like, I mean, what is that going to bring? Because that brings a lot of uncertainty. However, as kind of the presidency unfolds, I think the uncertainty actually dissipates. And if you think about market volatility, the market is actually not scared about kind of any outcome, but what it's most scared is about uncertainty. So I think between now and when we get the election outcomes, there could be more market volatility because of the uncertainty that's going on. However, as I said, like, it does not affect kind of long-term returns.
Fantastic, thank you. So there is a question from Stephen. Maybe I'll respond quickly. So Stephen is asking to put my cash to work, or rather money in bonds to work harder in equities. So he's thinking, how can I get my money that is currently invested in bonds and push it in equities? Would it be as straightforward to move my risk profile from 16-18% to 22-26%, which will rebalance my portfolio to be more into equities? So maybe I'll answer this. So Stephen, the short answer is yes. As you increase your risk profile within a Stashaway portfolio, so in ERA, you go from Stashaway risk index 16% to Stashaway risk index 26%, you are in practice changing your portfolio, which also will mean you're going to have less bonds and more equities. Obviously, this will come with a bit more volatility, and as over the long term, higher expectation of return. But over the short term, it might go one way or another because of higher volatility.
Yeah, but also I would say that when you think about these Stashaway portfolios, we actually design them so that you don't have to switch your risk levels from time to time, right? I think the two considerations that I would use to select a Stashaway portfolio is, number one, what is the time horizon for that particular investment. Because I mean, you can set up as many portfolios as you like on Stashaway, right? I think, Michele, you have what, 10, 15 portfolios?
I lost count. Yes, I have
yes, exactly, right? So
four university funds for my 4 kids, one retirement funds, and then I have a bunch of other things. Yeah, I probably have
exactly
12.
right. So I mean, for your longer term goals, you can actually set up Stashaway portfolios with higher risk. And for your shorter term goals, that those should be kind of lower risk. So that is one consideration. Like, what is your time horizon? Why are you investing? What are you investing them for? And then the second criteria is kind of your own risk appetite. If you think about these SRIs, they give you a very good guideline as to think about the drawdown risk. Meaning that, let's say you choose a 36% SRI, right? There is a chance, let's say tomorrow, I don't know, like COVID hits, that portfolio could go down 36%. And the key is to ask yourself, can you actually hold through that 36%, right? Can you actually see through it? If you think that's too risky for you, then maybe, I mean, having a lower risk is fine. Because I kind of the adjustments in terms of cash and equities, I mean, that's what we have done for you already. So in your 22% portfolio, for example, we have already increased risky asset allocations. So I think as a Stashaway customer, we want to make sure that the hard work is actually done by us, not you. So that's the way I would think about kind of the SRI portfolios.
Thank you, Stephanie. I think we can go with the last question. There has been 4 or 5 different people that ask a question on AI. So let's split it maybe in 2 parts. The first part is, how do we use AI from an investment management perspective? I guess that's the broad way to ask the question. There was some smaller thing, and then I'll ask this to you, and then maybe there is a second question that I can address, which is, how are we using it elsewhere? So not in investment management, but in other areas. So maybe I'll let you answer.
Sure. Yeah, I'll take the first part. You take the second part.
Correct. Yes.
Okay. So I think so I actually studied AI when I was there for over 25 years ago. And back then, of course, AI was very, very different. So when we talk about AI today, we talk mostly about generative AI, which is one subset of AI. And but there are other kind of set of AIs, for example, machine learning, for example, AIs that are much more closely related to statistical analysis. And I mean, frankly speaking, we've been using those other parts of AI in our Stashaway kind of portfolio construction for quite some time. Of course, like Gen AI is kind of the latest shiny new toy. Frankly speaking, I don't think in kind of portfolio management, there is kind of widespread adoption of Gen AI into kind of running portfolios or kind of generating investment advice. But I mean, of course, things change very, very quickly. And some areas which is interesting is, for example, like sentiment analysis, where kind of the AI helps to analyze Fed speeches, etc. So a lot of these kind of tools we use as reference, but I think from a kind of portfolio Stashaway construction perspective, mostly we're using kind of statistical analysis and some AI techniques that helps with that those statistical modeling. So perhaps, I mean, Michele, you can talk about other parts of Stashaway.
Yes, absolutely. So thank you for that, Stephanie. So in general, we are obviously looking at AI from a variety of different perspectives. The one piece where we are doing quite a bit of work is, how can we, each of us, use AI to be more efficient, more effective in our work. We are looking at also at team base. So there are some teams where there are clearly some very large benefits, or some obvious one, engineering with all the co-pilot type of products that have been out there, marketing for ideation, for copywriting, for kind of building the first drafts and actually advanced drafts, or building the kind of first draft of designs, etc. So there is quite a few things that we're already doing there. Customer support, we're working to provide help to our customer support agents with kind of AI help, kind of easy in their way of kind of finding answers and drafting answers. So those are all things we're doing. There was a question on whether we're going to use it for personalization. I think there is a lot of potential use cases on using AI on the front end for personalization. It's not as straightforward. So those are some tests we're doing and we will be doing. I think it's going to be a longer journey on that side, so on a customer-facing front. In fact, I haven't seen a lot of that yet in any app, but I think this is something that we'll continue to look at and trying to, our goal is never to start from the technology, but it's always to start from the client's problem. and trying to find the best solution. And oftentimes the best solution is the simplest solution. And so that's the angle that we take when we look at technologies. AI is just another technology. We look at it the same way. I would like to close the call here because we have now half an hour past what we promised we were going to do. I actually want to thank everybody that has been on the call for so long. Thank you so much. Stephanie, thank you so much for first of all, for the presentation and for being patient with my questions. I also want to thank a lot, all of our colleagues that have been in the background responding to a number of the questions. All the kind of written questions were answered by some of our colleagues. And as a reminder, the QR code you see on the screen right now, you can scan it to then ask, get in touch with us and ask us more questions if you want, or obviously you can write at support at stashaway.com. Oh, yes, there is actually this QR code that we missed earlier.
Yes.
That mistake. Which is a free investment Stashaway. So if you just scan the QR code and you're not a client, you'll be actually able to invest free of charge for, I believe, 3 months. This works across all the 5 countries where we are. So maybe we should leave the QR code on for a little bit, Stephanie, before people close down the call, so that you can actually use this. In the meantime, thanks everyone.
Thank you.
Thank you, Stephanie.
Thank you, everyone. Have a great night.
Thank you.
Thank you, Michele.
Thank
Bye.
you. Bye-bye.